Hi everyone, welcome back to Financial Mindset. In this video, we will learn about basics of financial markets. So have you ever wondered what happens when you buy a stock or how businesses raise millions of dollars without taking loans from banks? Behind all of these are financial markets. So the first question that comes to our mind when we hear of financial markets is what exactly is a financial market? In simple words, financial market is any platform where financial instruments like shares, bonds, currencies, etc. are bought or sold. We can say that it is a system where savers meet spenders or risk meets opportunity. Let us take an example for better understanding. Suppose there are millions of investors with capitals and hundreds of businesses with need for funds. The financial markets helps them connect with each other efficiently. Next on we will discuss what exactly is the need for financial market. So the financial market solves two major questions which are how do we transfer money from people who have it to people who can use it, or we can say that from investors to businesses. The second question that it solves is how do we do it with trust, speed and transparency. Now we will discuss who are the participants of financial markets. Participants include retail investors like you and me, institutional investors like FIIs and DIIs, large business corporations who need funds to operate, governments, and finally the regulators like SEBI in India and SEC in the US who ensure fair and transparent market operations. There isn't just one financial market, there are many. We will discuss them one by one. So the first one is the capital market. These are the long-term markets used to buy and sell shares or bonds. The capital market can further be divided into primary and secondary market. The primary market is that market where new shares are issued using the process of IPO and FPO. So to make things more clear, we will use an example. So suppose that there is a company that needs funds to expand its business and it decides to go public and issue new shares to public for the amount it requires. In this case, it will go through all the due diligence in the primary market. Now we'll discuss the secondary market. The secondary markets are those markets where existing shares are traded. We will continue with the same example. So assume that the company has finally completed all the process in the primary market and the shares are issued to the public. The company is finally listed on the stock exchange like NSE or BSE where day-to-day trading takes place. These exchanges basically are the secondary market. So the next one is the money market. The money market deals in the short-term debt instruments. We can think of them as financial world's quick loans. Some of the money market instruments are T-bills which are issued by the governments, commercial papers which are issued by large corporations, certificate of deposit issued by banks offering fixed interest rate for short duration. Now imagine a situation wherein a large company needs 500 crore to pay suppliers and workers for the next 3 months. Instead of taking a long-term loan, it can issue commercial papers in the money market. Now the next on is the derivatives market. Derivative market is where contracts are based on underlying assets. Derivative instruments like futures or options derive its value from underlying asset. Underlying asset can be anything like stocks, commodities or currencies. We will firstly understand two terms, futures and option. Future is an agreement to buy or sell asset at a future date at a fixed price. Options gives the right but there is no obligation to buy or sell at a certain price. For better understanding, we will use an example. Suppose that there is a trader who expects gold price to rise in the next 6 months. Based on his expectation, he can either buy physical gold or he can buy gold futures. So the natural question that comes to our mind is what's the difference in these two? Buying physical gold is more safe, but it requires more capital as well as a storage space to keep the gold. Now we assume that instead of buying physical gold, he buys gold futures, which is done by majority of the traders. So in this case, he just needs to pay margin amount and not the full amount. It definitely is more riskier as futures price will daily be updated. With it, margin requirement will also change. Most traders use futures because they don't want physical delivery of gold or suppose any commodity. We will learn more about derivatives market in some of our upcoming videos. So the next one is the commodities market. Commodities market is where raw materials like agriculture products, metals, energy like crude oil, etc. are traded. It includes both spot and derivatives market. Some of the commodity exchanges are MCX in India, CME, CBOT, ICE, etc. in the US and UK. So finally, the last one is the foreign exchange of FOREX market. It is a global currency market where daily trillions of dollars are traded. Daily traders, importers and exporters trade on currency exchange worldwide. Just for better understanding, we will use a short example that suppose a trader analyzes that GBP will rise against USD, so he will buy GBP USD pair in the currency market. So this was all about basics of financial market. Just for a recap, we have discussed in this video what are financial markets, need for financial markets, participants of financial market, types of financial market. For more such videos, stay tuned with the channel and do like, subscribe and share.